All right, let's get right into it. Today, we're going to pull apart one of those golden rules of investing. You know, the kind of wisdom that feels so right, but can actually be one of the most dangerous traps out there for your money. We are talking about why betting on the perfect team is often a catastrophic losing strategy. I mean, you've heard this a million times, right? Bet on the jockey, not the horse. It's practically gospel in investing, from Silicon Valley all the way to Wall Street. And the logic is just so seductive. A brilliant founder, a visionary leader, that's the jockey, can supposedly steer any idea, any horse, straight to the winner's circle. We love hero stories, and this fits right in. The only problem is, it's often dangerously wrong. And look, the numbers here are kind of staggering. A full 78% of American investors admit that they make decisions based on emotion. That little gut feeling you get from a charismatic pitch, that's not some special insight. It's a cognitive trap, and it's blinding us to what really matters. So here's our game plan. We'll start with the myth of the jockey. Then we'll dive right into the charisma trap, and its pretty high cost. After that, we pivot to the solution, building a system, not looking for a savior. And we'll wrap up with exactly what you can do about it next Monday. All right, first up, betting on the jockey. Let's really break down why this seductive idea is so often a myth.
So why do we keep falling for it? I mean, what is going on here? Well, it all comes down to psychology. Welcome to the charisma trap. It's like a cognitive loophole that our brains are just hardwired to walk right into.
To really get this, we got to look at the work of Nobel laureate Daniel Kahneman. He said, we have two ways of thinking. A passionate, visionary founder totally lights up our System 1 thinking. That's the fast, gut reaction, emotional brain. We feel inspired, we feel connected, and this just completely bypasses our System 2 brain, the slow, analytical one that's supposed to be asking all the tough questions.
And this leads us straight into something called the halo effect. It's simple, really. We see a founder who's a fantastic public speaker, and our brain just automatically assumes, wow, they must also be a brilliant financial strategist and an operational genius. That positive impression of their personality creates this halo that makes us just accept their entire business plan without question.
Now, this isn't just some abstract psych theory. This stuff has a real-world cost, and it can be huge. This brings us to Section 3, the high cost of hype, where all that charisma can lead directly to catastrophe.
Let's start with Adam Neumann. See, he wasn't selling office space. He was selling a vision of global consciousness and community. His energy was so captivating that sophisticated investors poured billions into what was, when you stripped it all away, just a real estate rental business with massive holes. This was the halo effect on full display. His amazing storytelling created a halo that made a flawed business model look like absolute genius. They bought the story, not the balance sheet.
And then you've got Elizabeth Holmes. She masterfully crafted a persona, down to the black turtleneck, all to sell a story about changing the world. I mean, that narrative was a direct rocket launch into investors' System 1 emotional brains. It was so powerful that it convinced seasoned experts to completely overlook one tiny, fatal detail. The technology she was selling didn't actually exist.
And this isn't ancient history either. Just look at Sam Bankman-Fried. He was the perfect modern jockey. The MIT genius look, the compelling story about effective altruism. His story was so good, it let investors shut off their analytical System 2 brains entirely. They bet on him so hard, they completely forgot to ask the most basic question in finance. Hey, is the money actually there? His charisma was the perfect cover for one of the biggest frauds we've seen in a long time. And you might think, okay, those are billion-dollar blow-ups. But the same trap gets sprung on everyday investors. This bias has a real cost. Research shows that the average investor can lose as much as 2.5% in annual returns just because of these kinds of behavioral mistakes. Over time, that is a massive drag on your wealth.
And this trap is absolutely everywhere in our financial lives. You buy a stock because the CEO gave a great interview. You overpay for a house because the seller told you a touching story. You pile your 401k into a fund run by some star manager who's all over the news. Every single time, you're letting emotion and a good story drive a financial decision. So if we can't trust our gut, what can we trust? The answer is a system. This is the antidote, a disciplined, repeatable process that is specifically designed to protect you from your own worst emotional instincts. So how do you build this thing? Well, it really rests on 3 principles. First, you got to widen your focus.
You have to analyze the business separate from its leader. Second, build yourself an exit button. Know exactly how and when you'll get out before you even get in. That way, emotion can't trap you. And third, constantly update your playbook. You gotta stress test your ideas against new information, not just coast on old beliefs. And here is a super practical tool to do just that. Think of it as an anti-bias checklist. Before you invest, force yourself to list 3 solid reasons this could fail. That helps fight confirmation bias. Then describe the business in one boring sentence. That fights the narrative fallacy. Ask yourself if you're only interested because a bunch of big names are in on it. That's how you counter herd mentality. And maybe the most important one, if I didn't own this today, would I still buy it? That is your weapon against the sunk cost fallacy. Every question is like a shield.
Okay, I know this has been a lot of theory. Let's make it real. Here are your first steps to building a smarter system, things you can literally do this coming Monday.
So here's your assignment. First, take a look at your biggest winning investment and be honest with yourself. Was it the genius leader, the underlying business, or were you just lucky? Second, look at your biggest loser. Go back to that checklist and pinpoint the exact bias you fell for. Think of that loss as the tuition you paid for an important lesson. And finally, just pick one thing you own right now and run it through that anti-bias checklist. The whole goal here is to start practicing, to see your investments through a lens of pure logic. So I'm going to leave you with this one question, and it really gets to the core of everything we've talked about today. In your financial life, are you building a system, or are you just looking for a savior? The answer to that question will probably determine your success.